So, what is a commercial mortgage and how do they differ from home loans? In this video, I'll clarify this question and go over the differences between the two. Hey everyone, it's Doug Cotton here from Right Angle Group, your property finance specialist, where I talk everything finance for property investors and developers. If you're new to the channel, make sure to click that subscribe button so you're notified of any new content that I upload. So what's a commercial mortgage loan and how do they differ from home loans? Well, commercial mortgages are essentially loans secured by commercial properties such as an office building, retail shop, industrial warehouse or residential apartments. The proceeds of a commercial loan are typically used to acquire, refinance or redevelop commercial property. Commercial loans are typically structured differently to home loans given how banks and other lending institutions assess the risk associated with the borrower and the particular asset that's either being acquired, refinanced or redeveloped. So how are they structured differently? Well, the main differences are with the loan to value ratio or LVR, loan term, interest rate and security items. Most lending institutions in Australia will lend a maximum LVR of 65% for a commercial loan. That being 65% of the value of the asset. It much depends on the lender and their appetite towards the particular asset. Loan terms don't normally extend as far out as a home loan term. The maximum I've seen is for a 20-year term. Usually commercial loans are of a short-term nature and range anywhere from a 1 to 5 year term and are normally interest only. They can be reviewed annually by the lender who checks up on the account conduct as well as how the borrower is tracking financially as well as whether they're meeting certain post-settlement loan conditions. Interest rates can fluctuate but are normally higher than a home loan rate. This is where the risk-reward principle applies. Depending on the lender, they can either be charged at a flat rate or structure the rate such that it's broken up into parts. The terminology of each of these parts can vary, but are typically known as the base rate and line fee. The base rate is calculated on the drawn balance of a loan. The balance of the loan can fluctuate, particularly if it's in overdraft or line of credit or whether it's progressively drawn on by developers or paid down over time. The line fee is charged on the approved limit of the loan. It could be thought of as a set fee charged each month to the loan. Normally with your home loan, the lender will require either just a registered mortgage over the house or the mortgage and a guarantee from someone, depending on who is borrowing, who owns the asset and whether additional income is required from a servicing perspective. Typically the borrower of a commercial loan isn't an individual, though it can be but not very often, and is usually either a company, trust or partnership. If the borrower is a company, the standard security items a lender will require are the commercial mortgage, personal guarantees from the directors and shareholders and a general security agreement or GSA. This is a full recourse position for the bank. The GSA, previously known as a mortgage debenture, is a charge over the fixed and floating assets of a company. The charge is registered with ASIC and the Personal Property Securities Register, or PPSR, which is a national online register used to let others know that you have a security interest in a particular good or asset. Commercial mortgages and home loans also differ in how they're regulated. Given home loans are normally underwritten for personal use, they're regulated by the National Consumer Credit Protection Act, or NCCP. The NCCP Act was set up to protect the interests of the everyday person when it comes to consumer credit. It requires both the lender and mortgage broker to take reasonable steps to determine whether a loan is not unsuitable for an individual during the loan application process. Commercial loans aren't regulated by NCCP, but are self-regulated by the Code of Banking Practice, if it's a bank. This is a form of industry self-governance which was established as a set of promises outlining how a bank should conduct themselves with dealing with individuals and small business in the provision of credit. Whilst the code does provide for protection to business, it's not as draconian as the NCCP, which allows commercial lenders some degree of flexibility around their lending policy. This means that the loan application process is not as black and white as a home loan. Lenders can make commercial decisions on borrowers, an example of which might include a borrower who lacks experience with undertaking developments, but has surrounded him or herself with a good and competent team of those that are experienced. Given the inexperience of the borrower has been somewhat mitigated by a good consulting team, A lender can overlook this fact. Well guys, I hope this has been helpful and informative, and I'll look to upload more videos and content in the future which will expand on some of the points I've spoken about in the video. But look, stay tuned guys.